So they call audit risk the risk that the auditor will give the wrong opinion on the financial statements, the risk that the auditor gives an unmodified opinion when the financial statements do not present fairly. So even after a complete audit has been done, there's still that risk. Why is there that risk? Especially if you're a good auditor. Because audit risk on slide 3 is a chance. It's the chance that first, a material misstatement will occur or has occurred in the company's accounting process. So what's the chances of that? It's certainly not zero. The chances that there's a material misstatement in the accounting somewhere. And audit risk is the chance that the material misstatement won't be detected by the company's own internal controls. And audit risk is the chance that those same errors will not be detected by the independent auditor either, so that those errors wind up on the financial statements even after the audit. So audit risk is concerned not only with what, but also why and when. Because if you're concerned with the chance that the material misstatement has occurred in the company's accounting process, but you haven't looked at the internal controls and considered them yet, then what part of audit risk are we talking about? We're talking about inherent risk. If we're just interested in what's the chances that there's a material misstatement in the accounting process before we look at the controls and take them into account, then we're interested in the inherent risk, the built-in risk of errors in the financial statements without taking into account or before taking into account the controls. Now, if we're interested in those same errors and what's the chances that those errors are there after we've already considered the controls, now we're talking control risk and not inherent risk. Because we've already considered the controls along with the errors. What's the chances those errors are there after we've considered the company's internal controls? That's a control risk situation. And then those same errors, what's the chances that not only did the company's internal controls miss the errors, but what's the chances that we, the independent auditor, miss the errors? Now we're talking detection risk. And all three are part of audit risk: inherent risk, control risk, and detection risk. And when you say you sometimes get the questions wrong, it's because they're worded in such a way where more than one answer looks like it could be right. So you have to look at what time period are they asking about. Are they asking about just the errors before considering the controls? That's inherent risk. Are they asking about the errors after considering the controls? What's the chances the errors are there? What's the chances the errors are still there, that they didn't get caught by the controls? That's control risk. Or they want to know about the independent auditor. What's the chances that the errors are there after the independent auditor's finished doing the testing? That's detection risk. And audit risk is made up of all three of those. And go to slide 4, because audit risk still exists even after the audit, because the auditor is only providing reasonable assurance that the financial statements are presented fairly. So audit risk and reasonable assurance are very closely related. The idea that there's still a residual of audit risk because we can only give, the best we can do is give reasonable assurance. Why can we only give reasonable assurance that the financial statements present fairly? Why can't we do better than that? Why can't we give absolute assurance or perfect assurance that the financial statements present fairly? Well, we could do it if we looked at every piece of evidence. But do we look at every piece of evidence? No. We only test based on sampling. We sample for our evidence. We don't look at every check or every transaction or every purchase order, every invoice. We just sample. And because we don't look at every one in the population, we only look at a sample, we can't give perfect assurance. We can only give reasonable assurance. And reasonable assurance can only be given if audit risk can be reduced to an acceptably low level. So we can only give reasonable assurance, that's the best we can give, and we can only give it if we could reduce this audit risk to an acceptably low level. So let's get to know the components of audit risk. On slide 5, we said audit risk is made up of inherent risk, control risk, and detection risk. Let's start with inherent risk, since that is the first one out of the box in any audit. Because inherent risk is simply the possibility of a material misstatement before considering the company's internal controls. So inherent meaning built in. What's the chances that a material misstatement will occur or has occurred within the accounting system of the reporting entity? What do we do about this inherent risk thing? What's our responsibility toward inherent risk? We have to assess it. That's all. We just have to assess it. High risk, low risk, at the maximum, below the maximum. We have to assess inherent risk. Our assessment is the best we can do to determine how much risk we think there is that there's errors in the accounting system before looking at the controls. No internal controls could minimize inherent risk because inherent risk is prior to looking at the controls. We're assessing inherent risk before we think about the controls. So no amount of controls can really help us here if we're just trying to assess inherent risk. We can't do anything about the amount of inherent risk that there is. Even by doing good auditing procedures, we're not going to be able to change the amount of inherent risk that there is because it exists independently of the audit. That risk is already there before we get there. And if we never come because they don't get audited, the risk is still there. What risk? The risk that there's material misstatements somewhere in the accounting system, and that'll end up on the financial statements without taking into account the controls. That risk is known as inherent risk, and that risk is there in any company, whether they're getting audited or not. The only reason we're interested in that risk is because we're going to assess that risk because we want to know how much risk we think we're facing so that we can respond to that risk later on by doing some audit testing. If we think there's a lot of risk, we'll do a certain number of tests that we may not need to do if we don't think there's that much risk. So we'll assess that inherent risk and then respond to that risk with our testing. So that's why we want to know about the inherent risk, even though it's really a client characteristic and has nothing to do with us. So go to slide 6. Inherent risk must be assessed by the auditor. That's what we do with inherent risk. We just assess it. Nothing else we can do about it. It has to do with the people in the system working for the client. Our assessment really has nothing to do with the actual level of risk, but we want to assess it so that we can respond to our assessed level of risk. What do we think of the people who are working for this client, especially in the accounting department? Because that's where the financial statement errors would come from, if they're there. So what do we think of those people? We know people aren't perfect, so there's going to be a risk here. But is it going to be assessed by us high or low? That's up to our judgment. And inherent risk is assessed in the planning stage very early in the audit. So in the planning stage on slide 7, we will assess the risk that material errors exist in the financial statements. It's got nothing to do with the actual amount of errors. Our assessment of inherent risk has nothing to do with the actual amount of errors or the size of the errors, because we haven't even looked at the errors yet. We haven't even looked at that yet. We haven't even done any auditing testing yet. We're just going to assess inherent risk without looking at the controls and without having done any testing yet. Just what's the chances of material misstatement? We have to assess that risk and respond to it by either doing more testing or less or the same amount that we figured originally. So let's get into some reasons to assess inherent risk high on slide 8. For example, if turnover in the accounting department is high at the client company, that's a reason to assess inherent risk higher. If you have people turning over in the accounting department, then you have different people making journal entries all the time. There's more of a chance that somebody in the chain doesn't really know what they're doing or didn't know what they were doing while they were the ones making the entries. So high turnover in the accounting department, that's a reason to assess inherent risk higher. Doesn't mean there's a problem. It just means we're going to assess the risk of problems higher if we see high turnover. Another reason to assess inherent risk higher is if the accounting department personnel are not CPAs. So if the people making journal entries for a big company are not CPAs, then what's the risk? The risk is they may not know basic GAAP rules, and the company's financial statements might be a mess. So these would be reasons to assess inherent risk high. A lot of turnover in the accounting department. Accounting people are not CPAs. Doesn't mean there's problems. It just means that we're going to assess the risk higher. What's some more reasons to assess the risk higher? So here's some more reasons to assess risk higher. If there's many accounting estimates, if many accounting estimates are present in the financial statements, the greater the assessment of inherent risk, because estimates are subject to management bias. See, the thing that a lot of people don't realize about financial statements is how many expenses on the income statement are based on estimates and they're not actual information. They're not actual figures. They don't represent anything like the cash paid, right? Your expense for interest is not the same as the cash paid for interest. Your expense for bad debts is not the same as the amount of bad debts that actually went bad. That doesn't represent the customers that declared bankruptcy. The amount of bad debt expense on an income statement does not represent the amount of customers who declared bankruptcy. There may not have been any customers declaring bankruptcy, and yet you still have a bad debt expense. Why? Because so many expenses, like bad debt expense, are based on estimates. You want to match the current year expense against the current year sales. Match the expense against revenue in the same period. That's where a lot of expenses come from on an income statement. Well, that matching requires an estimate. And who gets to make that estimate? Management. But every time management sits down to do an estimate, there's potential for bias. So if we see a lot of expenses based on estimates on an income statement, the more we have to increase our assessed level of inherent risk. Doesn't mean there's a problem, just means we're going to assess the risk higher. We know certain accounts need to be estimated according to GAAP rules. Bad debts is one of them. Depreciation expense, right? There's another. Useful life is an estimate made by management when you do depreciation calculations. There's a lot of expenses based on estimates. Warranty expense is another one. When you look at a warranty expense for a manufacturer, that's not based on what they spent to fix broken products. That warranty expense is an estimate. And who came up with that estimate? Management. So it's subject to bias. What's another expense subject to bias because it's all estimates? The biggest one by far. Pension expense. Pension expense is completely based on estimates. If you did FAR, you saw that there's 6 components of pension expense. And they're all based on estimates. So the more estimates present, the higher the assessed level of inherent risk. Doesn't mean there's a problem. It just means there's more opportunity for a problem. So we have to assess the risk higher and then respond to the risk by doing more testing. How about some more reasons to assess inherent risk high? Well, if there's a lot of related party transactions present, that's like the dirty word in an auditing, right? Related party transactions. But really, there's not necessarily a problem just because the client has a wholly owned subsidiary or a equity method investment and they're buying and selling to each other goods and services. That's not necessarily a problem, but we are going to assess the risk higher because there may not be legitimate business purpose behind some of these related party transactions. And we've been in other situations in auditing where related party transactions have been used to cover fraud. So that's why when we see a lot of related party transactions, we're going to have to assess the risk higher and respond to the risk. Another reason to assess risk higher is if accounting transactions are complex. If it's hard to determine when revenue should be recognized for an entity, you're going to have to assess risk higher. For a hedge fund, for example, if you're auditing a hedge fund, well, how do you know when they earned money? How do you know when they should recognize revenue? Much higher risk, inherent risk, auditing a hedge fund than auditing Walmart, who recognizes revenue when a customer brings a shirt up to the cash register. That's revenue recognition for Walmart. A lot easier to see it. Not a complex situation, right? So the more complex and difficult to determine when revenue should be recognized, the higher the assessed level of inherent risk. Doesn't mean there's a problem, just means there's more opportunity for a problem, so we'll assess the risk higher. Also, well, Enron was an example too, where it was so complex that the auditor really didn't understand when Enron was recognizing revenue. They didn't understand the business model, and Enron had to explain it to them and say, well, this is where we recognize revenue, and eventually they just lost the independence there. So inherent risk will be assessed higher whenever complex accounting or related party transactions. So on slide 11, inherent risk, let's summarize inherent risk, and then we'll move on to control risk and detection risk. Inherent risk is part of overall audit risk. Inherent risk is assessed by the auditor very early in the audit process, in the planning stage. Auditor will either assess inherent risk high or low, depending on factors like the client personnel being CPAs or not, how many related party transactions they find, what's the turnover like, how many estimates are in the financial statement. These would all be reasons to assess inherent risk higher. And although the auditor assesses inherent risk, this assessment has nothing to do with the actual level of risk. The actual level of inherent risk has nothing to do with our assessment. Yet we have to assess it so that we can respond to it. Number 12, which of the following will cause the auditor to assess inherent risk high? And the choices are on the next slide. Yeah, we would assess inherent risk high with complex transactions, but few related party transactions. That wouldn't be a reason to assess inherent risk high. Many related party transactions would be. 15, which of the following will cause the auditor to assess inherent risk high? Yeah, management relying heavily on estimates. That's a reason to assess inherent risk high because estimates are subject to bias. Low turnover, that wouldn't be a problem. High turnover would be a reason to assess risk high. We'll go with A. 18, inherent risk. One, exists independently of the audit. Does inherent risk exist independently of the audit? It does, because there's inherent risk in every company, whether they're getting audited or not. There's a risk that there's errors in the financial statements before we consider their controls. So yes, inherent risk exists independently of the audit. 2, Inherent risk is assessed by the auditor, but this assessment has no bearing on the actual amount of inherent risk present. And that's true also. We do assess inherent risk, and our assessment really has nothing to do with the actual level of risk that's present. We assess the risk for our own purposes so that we can respond to the risk. We can respond to the risk that we think we're facing. We may assess the risk very high, doesn't mean it's high at all. But if we think it's high, then we've got a lot of work to do because we think we're facing a lot of risk. We may assess the risk low. Doesn't mean it's low, it could be high, but we think it's low. So we'll respond to that low risk assessment by maybe doing less testing than we originally thought. So our risk assessment has nothing to do with the actual level of risk, yet we still have to assess it. Why? So we could respond to the risk. All right, now we go on from inherent risk to control risk. You ready?